Good morning, and welcome to the Energy Perspectives Group webinar by Hemisphere Energy, hosted by Hemisphere Energy. This event will be recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask the speaker, please type them into the chat feature. We will read and answer the questions at the end of the presentation. Thank you for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Okay, welcome everybody. It looks like we're going to have close to 40 people on the webinar today. Our speaker today is Don Simmons. He's the president and CEO of Hemisphere Energy. Hemisphere is a Canadian junior oil company. About 100% of their production is oil. Our production that they sell is oil because they're using the gas to generate electricity in their fields. I have been following Hemisphere closely for about 3 years. During that time, the company's production has tripled. Today, production is about 1,725 barrels of oil per day. Don Simmons is a petroleum geologist with extensive experience and a proven track record of discovering oil and gas in Western Canada and internationally. Don holds a Bachelor of Science degree in Geological Sciences from Queen's University, and he is a member of the Association of Professional Engineers and Geoscientists of Alberta. He spent 5 years with Encana, which recently changed their name to Ovintiv, and that's one of our Sweet 16 companies. For Encana, Don worked on various projects in Southeast Alberta and Ecuador. After leaving Encana, he was a geologist at a private oil and gas company, Sebring Energy, until its sale in 2007. And after that, he joined Hemisphere as the company's vice president of exploration, and he became president and CEO in February of 2008. Don has built a strong team at Hemisphere that knows how to find and produce oil at a profit, even during a pandemic at these low oil prices, and has very low operating expenses. And now I will turn it over to Don for an update on Hemisphere Energy. Go ahead, Don.
Okay, for some reason, there we go. Well, thanks, Dan, and thank you for the opportunity and the invitation to give an update on Hemisphere. I think it's been about 12 months since I was down and gave an update last year, and what a 12 months it's been. We've gone quite a wild ride over the last 12 months. So pleased to be able to have the opportunity to give an update, talk a little bit about what we did over the last year, and a little bit about where we're headed through the rest of 2020 and into 2021. So who is Hemisphere? We are a Canadian junior oil company. We trade on the Toronto Stock Exchange in Canada and the OTC in the US. We are a conventional heavy oil producer with low decline water flooded pools. Our current production, just over 1,700 barrels a day. And as Dan had mentioned, we're almost to 100% oil. And our area of focus is Southeast Alberta. We have an asset base down there. If you look at the map of Alberta, we're about a 3-hour drive east of Calgary, so quite easy to access. The closest town or city to our assets would be Medicine Hat, Alberta. If you look at the map, there's two main assets there, one called Jenner and another called Atlee Buffalo. And in this presentation, I'm really going to focus on Atlee Buffalo. It has been, the area that we've been focused on developing over the last number of years, and it will be our area of focus here for the next few years as well, with pretty significant opportunities down there. So I'll talk a little bit about Hemisphere's overall strategy. And as a junior, it really comes down to growing production, reserves, cash flow, continuing and looking to strengthen that balance sheet. And one of the things that we really lean on as a company and have for years is looking for additional ways to add value from our existing asset base. So if we dig a little bit more into these, when we talk about production growth, and it's not just production growth for the sake of production growth, what we're really looking for is cash flow growth and coming from good quality assets and good quality decisions that are made to increase that production and reserves. We entered into a 5-year term loan back about 3 years ago in September 2017. And since that time, we've grown our production from about 500 or 600 barrels a day to between 17 and 1,800 barrels a day where we are today. If we look more recently, from 2018 to 2019, you look at our reserve growth, just in our PDP, our proven developed producing category, we grew that volume by 50% year over year. And this growth has been through the drill bit, or organically, both through the drill bit and through expanding our water flood operations. When we look at the balance sheet and when we talk about strengthening that, I mean, certainly with 2020 and the volatility that we've seen, both with the demand hit from COVID and as well as the price wars earlier on in the year, we've had to switch focus. We certainly went into 2020 thinking we'd have a very similar year to 2019 from a drilling perspective. But with that volatility and changes in the market, we very quickly changed our direction as well. And we've been focusing and will continue to focus our free cash flow on reducing our debt. It just increases our financial flexibility as a company as we look to develop and move forward with our assets here in the future. We will be a little bit more active in Q4. We're looking at a couple of opportunities here. We will deploy some capital into expanding our water flood, which then is a way for us to increase our production and looking for some reserve growth. And one thing I'd like to mention, not so much so far in 2020, but we have always looked to invest capital into our facilities and our operations, and that's allowed us to maintain a low production cost, and it's key. When you look at the first half of 2020, we've been able to maintain operating and transportation costs below $10 a barrel. And I can tell you, when the volatility we've seen in the price so far this year, that's been a huge help for us in surviving and being able to remain positive cash flow position through these low price environments. And when a little bit more on the unlocking additional value, I mean, there's a philosophy that we've followed through most of my career, and certainly at Hemisphere. And if you've heard me talk or present before, you've probably heard me say this, but the best place to find oil is in an oil pool. And we look at these opportunities all the time. Something, maybe just optimizing existing wells, our water flood operations, investing in some of our facilities, but also one of the things we've been working on through the last 3 months when we're not drilling is looking at ways of tapping more of those unbooked and more of that oil that's in our reservoirs. And one thing we've been working on is looking at the potential to convert some of our water floods into polymer floods. And I don't have a lot of details on it yet, but it's something you're going to see from us talk a little bit more about it. And I think it's something we'll continue to push forward as we go through 2020 and into 2021. So 2019 seems like a long time ago, but I do want to bring it up. I want to do a bit of a review because it really has put Hemisphere in the position that we're in today. And it really was a huge year for us. Records on many levels, from cash flow, production, and the reserve side. We increased our average production through the year to 1665, again, almost all oil. We increased our revenues over 31 million. We increased our operating netback to almost 19 million for the year, or almost 31 million, or $31 per barrel. We increased our cash flow from our operations to over 13 million, and we reinvested just under 11 million in capex in new wells and facility expansion through the year. We managed to reduce our operating costs and transportation costs to below $12.50 a barrel for the year of 2019. And as I mentioned, we've been able to continue some of those efficiencies right into 2020. And so far for the first half of the year that we've reported, have had below $10 a barrel. All this has led to some fairly significant reserve valuation and volume increases at the end of the year. Our proved developed producing category, we had increased by almost 70%, and our volumes by 50% to almost 5 million barrels. On the proven side, we had increases of almost 40%, up to around $200 million, and our volumes by 30%, almost 10 million barrels. And on the proved plus probable category, increases of just under 20%, with the volumes increasing about 15% over 12 million barrels. So very significant year for Hemisphere, and we've certainly been able to reap those rewards. It would have been great to be in a better price environment for the first half of this year, but that's something we don't have a lot of control over, and we were still able to take that production and that cash flow and put it to use. Taking a little corporate snapshot, as I mentioned, we trade in Canada on the Toronto Stock Exchange, symbol is HME. And on the OTC in the US, the symbol is HMENF. Share price, when I put this together a week or so ago, we were trading around 13 cents. I think we're close to that today. Our basic shares outstanding, about 88 million shares. It's down a little bit, a couple million shares over the last year or so. We have been active in a share buyback program, and we will continue to be active in a share buyback program. Fully diluted shares outstanding is about 110 million shares. And when we look on the fully diluted basis, the insider ownership is about 27% of the shares outstanding. Market cap's pretty beat up. We're about 11.5 million in value there, enterprise value of just over 42 million. And when we look at some of the high level numbers for Q2, which arguably, for me, in my 20-year career, probably the worst pricing quarter I've seen, at least in a long, long time. We managed to have revenue of about 2.5 million, and our operating netback was about 17.75 per barrel. And that led to cash flow from operations of positive 1.4 million for the quarter. So, I guess silver lining in a terrible quarter, we still managed to be cash flow positive. Debt at the end of Q2 was just under 31 million Canadian. And right now we have a term loan facility. It's a 5-year term loan. We have 2 more years on it. It matures in September 2022. And that is a facility up to 35 million US, which equates at today's exchange rate to the ability to access up to about 46 million Canadian. Current production, or the last number in the market, is the 1725. Again, as I said, almost all crude oil. And the last point there is our LMR, or liability management rating. It's more of an Alberta energy regulator number. But it's a key thing for us. It's something, again, it sort of reflects the culture and how we look at acquisitions when we have in the past, and as we do now, and when we're looking at other ones in the future. It's a ratio of what is deemed as a value of our production assets against the liability, so future abandonments and reclamation costs. And what's that saying is we have about 12 times the assets to deemed liabilities in the eyes of the Alberta energy regulator, and that puts us in the top quartile of companies out there. And we've been very cautious in the acquisitions we've made over the years not to take on a lot of wellbore or facility liabilities, because it can really be an anchor on the company. And it's a philosophy we'll certainly continue in the future. I show this again just to give a little idea on our track record. This goes back to where we did our refinancing and signed the 5-year term loan. That allowed us the capital to go out and develop the assets that we have. And you can see there, fairly consistent production growth quarter after quarter. As you look out to Q2, yes, you see a bit of a drop in there. Some of that's reflected by some of the shut-ins, and certainly we halted all capital spending at the time, so not too surprised at a bit of a drop there. We still have some of our high cost wells shut in, and in a $40 environment that's fragile, not in a rush to go turn any of those back on right away. Again, here's a kind of graphically looking at that reserve growth over the last 4 or 5 years. Very consistent growth year after year, both on the value side and on the volume side. So again, it kind of speaks to two things. One, the asset base that we have and the opportunity that we have there, and also to the team and our sort of methodical approach to development of these assets. Now, I'd like to dive a little bit more into the main pools that we are developing in Atlee Buffalo. As I mentioned before, these really have been our growth pools, our focus on development for the last few years, and certainly over the next few years as well. There's two pools that we've been developing there. Very imaginative names. The F pool is one of them and the G pool is the other. You can see from the cartoon or the map in the right-hand side that the horizontal black lines are our oil producers, and the blue lines are our water injectors at this time. When we look at some of the numbers of these pools, in the F pool, it maps up at just over 30 million barrels of original oil in place and about a 5% recovery factor, or that's about 5% of the oil has been produced to date. When we look at the G pool, it's a little bit bigger. It's about 40 million barrels of original oil in place, and again, about 5% of the oil has been produced out of that pool. We have 100% working interest in both these pools. We own and operate all the facilities. We have excellent geological control. There's over 50 old vertical wells from the 70s and the 80s and the 90s that delineate these pools. We have very good handle on the size and the nature of these pools. We have 3D seismic coverage over both these pools, which helps us both in our drilling and our development of these pools. And we have initiated and are expanding water flood operations in both of these pools, which is key to getting higher recovery factors. And one thing I mentioned earlier, we're at the stage right now where we're looking at and evaluating polymer, or the conversion of from our water flood to potential polymer floods in these. Really just at the application process, facility design, but we think there's a real significant opportunity here in what we own. When we look at some of the pools in the area that are analogs to what we have, and I've been involved in a number of pools that are just like these pools in this area, we see some of these pools have achieved up to 40% recovery factors through water flood and polymer floods, and are still producing today. So we think there's why we believe there's a real great opportunity here. And to put that into perspective, last year our reserve report reflected on a proved plus probable basis about a 20% recovery factor. So we believe we've got some room to run there. When we look at the development plan, you can see here the additional lines or sticks on the map reflect future potential locations, both producers and injectors. So we've got a number of more wells to drill. When we look back at 2019 and our accomplishments, we drilled 11 wells. We expanded our facilities in the G pool. We got all those wells on stream. And then towards the end of the year, we were able to look at optimizing our production and our facilities and our existing water flood operations. As we come through 2020 and into 2021, certainly, as I mentioned before, shifted priorities a little bit from thinking in early 2020 we'd have quite an active drilling year in 2020. But with the price volatility, we said, hey, let's look at other ways that we can add significant value without drilling in the short term. And so we have been working and updating and have finalized some of our updates on our reservoir models. And that's leading us now, as we get into the fourth quarter and Q1 in 21, looking to expand our water flood for production growth. That will allow us to optimize some of our existing producers. And again, we're continuing to move those polymer project opportunities forward. So what's the prize? What's the potential that we're working for or working towards here? When we look at the Atlee Buffalo 2 pools, about 70 million barrels of original oil in place. Like I said, about 5% or 3.5 million barrels has been produced out of these pools. Currently booked on a 2P basis, or proved plus probable. At the end of last year, there's about 11 million barrels, or 20% of that oil is booked in our reserves. And if we can work towards a 35% recovery factor, there's an additional 10 million barrels just in our existing 2 pools here that we're working towards. So lots of potential and lots of value just in our own existing asset base. So why Hemisphere? Why own Hemisphere? Why buy Hemisphere? Why hold Hemisphere if you're an existing shareholder? I think it really boils down to 4 main things. One, we have the assets for growth, and they're proven assets. We have access to capital. We have an experienced team in place that has shown it can deliver. And last, I think it is, and there will be it's a great time to invest in energy. To go back a little more in detail on some of these, we look at these assets, they're high rate of return, minimal capital expenditures. Our wells are about $700,000 to $800,000 all in, and they're fast payout projects. We have multiple years of low risk drilling inventory, and our production it's long life, low decline. Because of the water flood, and we can see years and years ahead of production out of these pools. And you throw in that added potential for significant increase in recovery factors by converting to a polymer flood at a fairly low cost of capital. We have access to capital. We're well funded by our own cash flow, but then at the same time, we're backed by a very strategic partner that has provided the capital for us to develop the assets over the last few years, and is there for us over the next few years as we continue to organically develop these assets. We look at the team. I mean, we've been a team in place for quite a few years now, and we've learned a lot through the ups and downs and the volatility and the marginal commodity prices that we've been through this downturn. But we believe we've positioned Hemisphere in a very good spot to be able to continue to grow even in a low price environment. And if we happen to get into a better price environment ahead, it's some very exciting cash flows to see there. And time to invest. So, I mean, I don't have a crystal ball, but as Dan often tells me, and I think he probably relates it to the rest of you, they don't call these cycles for a reason. And we believe that the lack of capital that has been put into the industry over the last few years, the lack of access to capital today, both through equity and through debt, will have a flip side. There will be a flip side to this commodity price, and we believe we're positioned very well to take advantage of that. And that being said, I mean, Hemisphere's quite a simple story. I thank you again for the opportunity to give everybody an update, and I'm more than happy to take questions.
Okay, Don, you can hear me?
I can.
Okay, I'm back on. I got a couple questions to get us started. I updated a profile on you guys, and also updated my forecast model and sent it out to our members. So question number 1, since Hemisphere is not completing any new wells this year, how are you able to keep production from falling?
Yeah. Okay. Well, a couple things I'd say to that. One is, the type of wells that we drill, being more conventional in nature, is we don't drill wells that come on at 200-300 barrels a day and decline over their first 12 months down to 50, 60, 70 barrels a day. A lot of our wells that we drill, they come on in call it a 60 to 120 barrel a day. And with a water flood in place and continuing to expand it, we don't see those big declines. In fact, in areas of the pool where we're expanding our water flood, a well might go from 100 barrels a day down to 50 or 60 barrels a day. We then expand the water flood into that part of the pool, and quite often we'll see incline in that area. Some of those wells going back from a 50 or 60 barrel a day back to about 100 barrels a day. So that's how we're able to manage large production declines that some other asset bases have.
Okay. Well, follow up to that is, I know it's fourth quarter last year, you got up to 2,100 barrels a day, but that's because you completed a big batch of new wells during that quarter heading into year end, and it came off a little bit from there. And then you did shut in what, a half a dozen wells or so?
Well, a couple of things that you're absolutely right. So that program that we did last year, all 11 wells, are all still producers today. We have not converted any of those wells to water flood or to injectors. And that certainly was like the plan going into that program, is we would have done some of that already. But they've been just such a good producers that we've kind of just rode that program through this downturn or the volatility in the price over the first 9 months of this year. So that's what we are looking at here as we go into Q4 and into Q1. We'll be looking at making a few of those conversions, which we believe will result in some production increases as we get into 21.
Okay. Next question is, how much your leasehold is held by production, and do you have any near-term drilling obligations under your leases?
So we hold everything that we are worried about or want to hold by production. So we have no near-term obligations at all. So we can dictate our timing on the drilling. It's all about when we feel comfortable going out and putting capital back into the ground and through the drill bit. We're able to do it our own timing.
Okay. Now I've got 3 people have typed in questions. So one of our USIN member here says, it's not easy for us to get US dollar trading quotes for Hemisphere, I guess in the OTC, other than guessing with the historical trades and guessing from Canadian quotes. Have you considered unlocking live quotes on the OTC website?
That's a great question. I didn't know I could, and I can definitely look into that.
When I look at it on Yahoo Finance, it's showing trades during the day.
I was always thought that it already did do that, but if there's something that I can look at or talk to someone or I'm more than happy to do that.
Okay, but you can see, I mean, if you go to even Yahoo Finance, it's hme.v on Yahoo Finance, and you can see there's a lot more active trading on the venture exchange there.
We certainly are more active on the venture exchange, yes.
Okay. And then you just, I'm using about a 75% differential between the Canadian and the U.S. Price. So, what I do? I got to get the chat box up here again. Okay. Next question. Guys, maybe I missed it, but what's the crude quality? And I'll add something to that. How do you determine the price in Canadian dollars that you get up there?
Okay, so it's heavy oil. So we range between 13 and 15 API for oil. And how do we get our pricing? So we do base it off WTI, and then we subtract off the Canadian differential. And today, for September, or I guess we've traded now for October, the differential is about $8.50. So if you walked through that today, we would be at $41 WTI today minus the $8.50, which would give you $32.50 US price, and then you times that into Canadian, which is a 1.32 times, gives us about a $43 Canadian price. Mm-hmm. And on average, we get, I'm going to say, about a $3 discount to that. And so we would be looking in today's price environment about a $40 wellhead price, Canadian.
No. And you're looking at a pretty nice, some cash settlements on your hedges for the third quarter, correct?
We do, yeah. For third quarter, I don't have it in front of me, but I mean, we're probably adding another $700 to $1 million in hedging gains through.
Yeah, I was guessing about a $5 or $6 a barrel uplift on your
Yes.
realized price. Yeah.
Yeah, and I didn't mention that I do have a slide later on, but we are hedged, quite well protected right through to June 2021. So we've got a number of swaps through to the end of this year in the mid 50 WTI range. And then next year, we've got a few different structures, but protection down to a floor of $40 on I don't have the volumes in front of me, but I, quite happy with our hedging position right through to the middle of next year.
Yeah. Okay. Yeah, I used that all added up to about a Canadian price of $42 a barrel that I used for the third quarter. Anyway.
Yeah, I would say, based on my numbers, that sounds very, very accurate.
Then the next question I have, go back to slide 8 in your presentation. And I noted that also. And he says, okay, let's see. All right. It says, with the stock price so low, and I looked, you look here and you say, okay, if you just take your 1P reserves, 198 over there in the far right column, 198 million, and subtract out your debt of like 31 million, and you divide by the share count, you're looking at $1.50 Canadian, right?
It's
or more than $1.50 Canadian.
Yes.
And I'm like, I don't know why somebody doesn't just buy the company and liquidate it. Now I know the 1P is based on a higher oil price than we have today, but if it gets the upside here for everybody listening is if we get back to a $55, $60 WTI price, that's the kind of a number you're looking at just for their 1P reserves. So he says, let's see, if the stock price so low, institutions can't invest. Are you considering a reverse split to get more potential buyers? And are you looking for acquisitions to grow?
So we'll answer the first one and we have talked about it, but to be honest, I mean, the institutions that are still left, at least on the Canadian side, we're not it doesn't matter what our share price is. It's really just a size of your company, your cash flows,
right,
and your production size. So, I think we're really geared to more retail and smaller funds aren't worried, at least in the discussion I've had, have not been worried about that.
Well, we've had several of our model portfolio companies do reverse stock splits, and it has not helped them. It hasn't done anything but lower their stock price even further.
Right. So I would echo that when a few companies in Canada that I've seen attempt that because they thought it would help them, it has not helped them either. What will help us and every other company, and again, I'll make this statement, if this was just a Hemisphere share problem, I'd say it potentially is my problem. But it isn't just Hemisphere, at least on the Canadian side, that is feeling the effects and trading at such low multiples. And again, that sort of speaks to the opportunity of timing. I don't know the timing, but in my 20-year career, I have never seen Canadian oil and gas companies trade at such low multiples.
I haven't either, buddy. It's unbelievable.
We talk about the opportunity. It's not just the growth in the company and the assets we have. It's also, we all believe that at some point we're going to need higher prices in order to meet demand once hopefully demand comes back from COVID. But also then, so there's upside on the on the oil price side, but there's an upside just on the multiples we're seeing.
Right.
And if we get back, I mean, we're trading. I mean, a lot of companies are trading at 1 or 1.5 or 2 times cash flow. I mean, that's just not where historically we've always traded, sort of in that 5 to 7 times.
Yeah, I mean, you're based on my 2021 forecast, assuming $50 WTI. We get back to $50 WTI. The stock is trading for a little bit over half of 1 times cash flow. And to remind everybody, this company is generating free cash flow, not just positive cash flow from operations, but free cash flow, which is cash flow from operations minus CapEx. And while we're on that, what's your capital expenditure budget for this year, for 2020?
It's low. I mean, we're
$1
probably
million or something, right?
Yes. Yeah. It'll be in sort of around $1 million.
Yeah. Because you're just doing some
conversions
and stuff out in the field, and that looking at the polymer study. Okay. Let's go on here. Oh, are you looking for other acquisitions?
Oh, we're always looking. Absolutely. I spend a lot of time scouring both things that I know, that are actively for sale, or corporations, but also just actively looking at assets that we would like to own. And I'll be completely honest with you, in North America, and certainly in Canada, which is more my focus, there are not many assets that make money in this price environment in order to acquire them and drill them and grow them. It is, and then especially you take on in Canada's case anyway, and I'm sure it's probably the same in the US. You're looking at these assets and you're like, okay, well, I like the opportunity, and if price goes up $10, this will make a lot of sense. But then they're saddled with 200 or 300 well bores that are no longer producing. Well, I'm not going to take those on and put an anchor around our neck to do that. So yes, we are, I would say, extremely active, but we haven't acted on a deal or anything in, it's been almost 4 years.
Yeah. Well, I mean, are there any like bankruptcies in that area or something? You might be able to pick up some properties.
Yeah. Oh yeah. No, there's lots of things you can pick up. It's just, when we look at them, we don't see something better than we currently have to look at, or something that makes a lot of money. I mean, I also, I don't mind taking some calculated risk and bets on our existing assets because I understand them extremely well. But taking a risk on an asset that might need $50 oil to make a profit, we're just not in that mode right now. Nobody is, right? So those assets are going to be idled, and you know what? They'll still be there when oil does come back to $50, and we'll be able to act on them at that point in time.
Yeah.
But that being said, you don't find, like, Atlee was a diamond in the rough. We identified it years ago. We worked hard over a number of years to consolidate it and acquire all the different pieces of it. And it is just a gem. It might be heavy oil, but it is a cash cow.
Yeah.
And so we're constantly looking for other assets like that, but you don't find them unless you turn over a lot of rocks.
Right. Yeah. Can you explain just the basics of what does the polymer flood do? I mean, what does injecting polymer do inside the reservoir that makes it, strip more oil from the rock or whatever it does?
Right. Well, at its very basic, at its highest level, you're adding something to the water to increase the viscosity, which allows it to push the oil, more of the oil that you wouldn't recover with just water, and push that oil to your producing wells. So the idea of, you're going to spend some capital on polymer, you're going to need a skid and some additional facilities. Call it somewhere between $3 and $5 million of capital to do that. You're going to add some operating costs for your polymer. Again, depending on how much you're producing or how much effective it is, but think of it as a $2 to $4 increase potentially in your operating costs. But you're looking to gain somewhere between 5 and 15% recovery factor over and above what you would have got with your water flood. And so you run numbers like this, and it becomes a pretty exciting project when you've already got the majority of your facilities in place, your pipelines in place, a lot of your wells are already in place. It's a pretty neat looking project, and that's why we're moving forward and continuing to evaluate. But I'd say we're cautiously excited right now.
Well, I look at my model, and it looks like to me you're going to generate about $5 million of free cash flow over the next couple quarters anyway. So you could generate the cash flow, put it in the bank to fund that whole conversion to a polymer flood just in the next 6 months, correct?
Absolutely. Yeah.
Okay. And can you access these? Are these fields able to be accessed year round, or you have to wait till the summer?
So we can access year round. But that being said, we fluctuate between extremes of -40 in January for a week or two to +40 in August for a week or two. So our preference would be, and our timing right now, I mean, very high level would be, we'll continue to work through things through the cold winter, and you would want to be implementing these type of projects in the spring and summer.
Yeah, right. I have experience with that from being with Hess. It's very difficult to work with water floods when it's -20 in North Dakota or Alberta. Well, you can imagine.
Yeah. I mean, you learn a lot. Like a lot of our stuff is insulated. In fact, I'm heading out to the field next week for the first time since March, I think, or even February. And these are some of the things the guys are already starting to look at, is insulating. Anything above ground needs to be wrapped and heat traced and ready to go for winter.
Yeah. Now, okay, let's say you do this Polymer Flood next year. So that, would you do like a pilot project or something, take like 1 or 2 injectors in one part of the field and do that, and then just expand off of that?
Yeah, I mean, likely the way we're headed is to go right in. I mean, from what we're seeing and in the analogs that have done it, we've got lots of analogs close by. So we've learned from what, these other people have done in very similar assets close to us. And I think we're at a point where if we're going to do it, we'll feel comfortable moving in and going with one of our pools, or at least the majority of one of our pools, not just a small pilot, but heading right in.
Yeah.
I mean, the cost difference isn't a huge difference between doing, from an infrastructure point of view, a small pilot versus, a skid that's designed for your growth.
Well, to totally drill out each one of those pools, as far as just forget the Polymer Flood, but to drill the remaining locations and the remaining injector wells, what kind of CapEx are you talking about?
Oh, I think, we've got somewhere, I don't have it right in front of me, but probably another 20, 30 locations in there, right?
Oh, okay. I didn't know that.
We've got, at 600 or sorry, at 700 to 800,000 a pop. I mean, there's still CapEx to go. And I think it's something that, if we do a polymer, that may influence how many wells we need. Maybe we don't need as many. Maybe you can sweep a larger area with less capital. So those are some of the modeling that we've been working on and continue to fine tune.
Even at today's oil price, you're still generating $2.5–3 million of free cash flow, right?
Yes.
Of cash flow from operations.
Yeah.
So you could fund a 6, 8, 10 well drilling program next year just based with cash, nothing but cash flow.
That's correct. Yeah. I mean, you look at last year, we had 13 million of cash flow. We reinvested 11 million drilling 11 wells plus our facility expansion and a few other things. Yeah. So we've gone from a company over the last, so when we did that deal back in 2017, it was all borrow, right? And we borrowed in 2017. We borrowed more in 2018 to build facilities and to drill our wells. 2019 was really that big shift in the company where we went from not borrowing, but actually paying back a little bit of debt and using our cash flow to increase our production and reserves. 2020, not by choice, but basically just because of the volatility in the market, we've actually made it a payback debt, mostly payback debt, and planned for 2021. Yeah. And as we move forward in 2021, it'll be investing cash flow and, and if there's extra, of course, we'll continue to pay down debt.
Yeah. Just to clarify on this question, he asked, well, the Polymer Flood would add proven reserves in 2020 or 2021, but at the earliest, it sounds like to me, it would be 2021.
Definitely not proven reserves in 2020.
But it won't P2 maybe, right?
Yeah.
Okay. Here's another question. Are there any publicly traded companies, even albeit larger, compared in terms of operational performance that you can point to, and how does the market value them versus how does it value you? Or do you think you're being valued at a much lower price, let's say, than what's going on in Canada? Maybe is better.
Well, we have a list of our peers, and again, I don't have it in front of me, but that our CFO does after every quarter, and I can tell you that we're not trading terribly different than some of our peers that are bigger than us, even.
Yeah.
Right. This is just been a bit of a buyer's strike, and people, investors, and I'm an investor in oil and gas. I'm tired and frustrated too, but I still continue to pick away and increase positions because I believe there will be a flip side of this. I believe that there will be better days on all those levels we talked about. I pick companies that I see growth and opportunity, companies that have survived, $28 average price in Q2 and still had some positive cash flow. Those are the kind of companies and management teams I'm looking to put more money into. Yeah. And companies that I think are trading at, historic multiple lows, so that, there's a number of ways to win on these stocks. And, that there are a handful of companies like that in Canada, more than a handful. And now don't get me wrong, there's some companies that I think will struggle and don't have a phenomenal asset basis, but we're just it's a very interesting time. And
right. Yeah. But you're not having any problems with your debt holders at all. They're not worried about your balance sheet ratios or anything.
No, they've been extremely supportive through the downturn, the pandemic here, and yeah, we've had a long-term relationship. They're Houston guys. We I used to, when I down and update you guys, I'd always go and see them and spend some time with them as well. But
they probably rather you not pay it back, because then they have to find another place to invest it to get the interest.
I mean, they're happy for us to pay back too. I think they've allowed us and have been supportive in us growing the business and building the business, and we've I would say, as a Canadian company, it's been 6 years this downturn. Yeah. But we've been with these guys for the last 3 years, and certainly lots of ups and downs in those 3 years. But we've I think we've built a really, really strong, really good relationship.
Yeah, but you're much closer to the bottom when you can give a list of companies that are trading for less than 2 times cash flow, and I got a list, and it's amazing that these companies are still out there. And I guess it's because the companies that have made acquisitions that emerged, the deals are good deals, they've been punished by the market for picking up more acreage. It's just like they don't want you to grow anymore. They want you to just keep, pump out cash flow. Anyway.
And as you and I have talked, Dan, I mean, with very limited access to capital on the equity side in probably worldwide, certainly in North America, with now very limited access to debt in North America for sure. There's only one valve that if we're needing, again, 98 or 100 million barrels a day in the future, there's only one valve that can give in order to have that supply there, and that is the price side.
Yeah. I mean, if we get back to 101 million barrels a day of demand for refined products, and even if we get back to 95, which we're up in the low 90s now of a rebound in demand. Just U.S. production, the U.S. production is going to fall by 3 or 4 million barrels a day, just this one country. And I'm sure Canada is going to be down a little bit. As we spoke prior to starting the webinar, Mexico is going to be down close to 1 million barrels a day of production. So you got all these supply areas falling. At some point, demand is going to exceed that supply. And then there's going to be this big flip in the paradigm. Hey, what happened to the glut? We now have a shortage, and you can go from $40 oil to $65, $70, $80 oil pretty damn quick, because as, I posted a link to that Raymond James, Marshall Atkins made a presentation at that Hart Energy Mid-Continent Conference, and they see by 1 year from now a pretty significant shortage of oil, and it's not going to be, there's going to be no growth in supply unless we have much higher oil prices than we have today. So Here's another question. You mentioned it's not the stock price, it's the size of cash flow and or BOE today that institutions want to buy. In your experience, what cash flow size or BOE a day size do they look for? Well, it depends. I'll answer that first, and then you can answer it, Don. It depends on the size of the company. I mean, Exxon or Shell are not going to look at companies this size, but if you got some company that's like 10,000 barrels a day, adding 1,700 barrels a day is a pretty big deal to them. That's a nice stair-step move. So it depends on the size of the acquiring company, the potential buyers, I think, when you start looking at who does this. But I think there's also maybe some even private companies that would be looking to buy these type of reserves as a base asset. So, Don, you want to add to that?
Well, I think you're talking more of a corporate acquisition. I believe the question may have been more around sort of institutional buying in the stock. And here's what from a Canadian side, we have very few funds oriented towards buying energy names right now, just given the investment and the losses over the last number of years. And I'll tell you what they're buying is Suncor and Canadian Natural Resources, and they might come downstream to a company like a Whitecap that's 50,000 barrels a day production type thing, right? I mean, that is where the institutional buyers are. If they're buying any energy stocks today, that's the sizes that they're looking at. They're not coming down to a Hemisphere size in this market.
Yeah, and the reason why is it takes just as much like overhead cost to look at a little company as it does a big company. So you got to spread that over a lot of reserves. And if you've got to get it, SEC approved and stuff like that, it's kind of expensive with your bankers. So let's see. I had a couple. Oh, how are your hedges? I noticed it wasn't in your presentation today, but I think it's on your website. And I also have a table of the hedges on my forecast model at the bottom of the forecast model. If you download it to Excel, you can go, oh, here you go. Here you go.
Yeah, I threw it in the sort of appendix at the back,
okay.
Just in case a question did come up on it. So yeah, there's a bit of a summary there, so you can see here at the end of the third quarter, we've got 425 barrels a day that will at just under $56 WTI that will be rolling off. But then for the fourth quarter, it looks like it's just under $55, $54.85, 425 barrels a day. And then as we get into 2021, through the first half of the year, there's a number of different structures there. Some collars, both some straight up collars and then some three-way collars that really look to basically give us a protection down to a $40 floor, which for us we still make good money in a $40 price environment. It's not as great as it would be at 50 or 60, but it's still okay.
Yeah. Just for the listeners too, if you download the Excel version of my forecast model, you can go into the future periods and change the realized price at the bottom. Now, this model is built in Canadian dollars, but it's pretty safe to say they're going to sell their oil for something close to whatever your WTI. So if you think WTI is going to be 40 for all next year, you can put it at $40. If you think it'll be 50 or whatever, and then also put in like 65, 70 and see the upside that you're talking about. But even at $40 realized Canadian oil price, they should still generate operating cash flow close to $10 million Canadian, which would fund a decent sized drilling program or the initiation of the Polymer Flood. Is there anything else you want to add, Don?
The only thing I'd say is in the past, there has been on the Canadian side, some issues with egress and getting our oil out and seeing our discount increase and blow a little bit wider. We haven't had those scenarios, mostly because of the price of oil has been lower, and there is production that's either been shut in or declines haven't been replaced. So we're not seeing any issues on the egress as we sit here today. You brought up that the Mexico decline there as well. They've put out an article that they're going to be down. That really helps Western Canadian heavy oil producers. That will, if that's true, that will mean that heavy oil discounts will stay quite narrow as we go into 21 and 22. So all these lead to a good environment for Canadian producers.
Okay, well, that's it for now. Sabrina, you can go ahead and end the webinar. As we said, we will record this and put the recording up on our website and send it out to all of our members. So thanks a lot, Don.
Thank you very much.
Okay.